Look, I think at this point it's really hard to tell whether this is a soft patch or whether this is the beginning of something worse. Clearly, the risks to the market are rising. We have been spending a lot of time thinking about 2015-16 and the mid-cycle slowdown that we saw then. And if you think about what happened then, volatility picked up. There were two 10% plus drawdowns in the market, but we emerged from that in large part thanks to accommodative policy in the U.S. and China.
I was going to ask, did we emerge from that because of accommodative Fed or because of President Trump's election? Because so much of the data right now, you're exactly right, has taken us all the way back to 2016 pre-election levels.
Hard to say. I mean, you could argue that it was really China that got us going in that direction because oil prices, remember, had been falling in 2015. China launched a very massive stimulus program. And when China starts improving, that means commodities start improving, which means the industrials start improving. And then there's optimism around a new presidency and what Trump may enact. So a lot of similarities between here and there. I think the takeaway is not yet clear whether this is something worse, but the volatility is going to continue.
Bill, where do you stand on what this ISM services number means? I mean, obviously, we're not in contraction, but it was worse than expected. It was still a decline. And at this point, you could argue that the Fed would have fewer bullets, if any bullets, to really stave off any sort of recession in the economy.
Yeah, so I think I watched the services as part of, a complement to the ISM manufacturing. I think, so I'm going to take a little step back quickly and say, I think this started off these worries about the market were from the ISM manufacturing falling below 50. We took a look at it all the way back to when ISM started. And it's interesting enough, only 44% of the time does the U.S. economy fall into recession after the ISM manufacturing falls below 50. So it's not the greatest indicator, obviously, of that. And the interesting part is it's actually more dangerous for the ISM manufacturing, more dangerous for your stock portfolio for it to be extremely high. When it actually gets below 50 and we don't go into recession, you're up pretty nicely 86% of the time in the following year. So it's, one of those things where the market's more toppy, actually, when you get a really high reading on ISM manufacturing. Hopefully, again, you kind of go back to the 90s where we had 5 different times we fell below 50 and you had kind of some of these growth scares. And as long as it's a growth scare as we expect, you should still stay relatively positive on stocks.
For all those instances, Bill, though, do we see that weak manufacturing number spill over into the services sector? Because that's really at the heart of the fear right now, that services and, services are a proxy for the consumer effectively. And so the consumer is starting to feel the slowdown in manufacturing that we're seeing in the economy.
I agree. I mean, the hard part is, you're right, and services is a bigger part of the economy. Consumer is a bigger part of the economy now. The problem is we don't have as long of a data set there. But I just say, that is actually what we're focused on. We think the consumer is holding in, even though, yes, things are slowing down. You might say, well, employment, we'll see more tomorrow. But it's not falling off the cliff. And as long as people have jobs and we're seeing wage growth, we think if consumer sticks in there. You can make the argument to me, and I'd probably accept it, that the manufacturing sector of the U.S. is in recession. But what really matters, you're right, is the consumer.
Michael Farr, that tactical positioning has been really important this year. You can be in stocks like Costco and do great, and be in other parts of the market and have done really awfully, especially the more exposed ones to manufacturing and to that side. So tell us where you think investors should stay or start new positions with all of this happening now and as we watch the data.
Kelly, I think that with all of the volatility we've seen, this is kind of the warning sign that perhaps we're entering hurricane season and you ought to hurricane-proof your house. We've had enough warnings now that you should be having, I think, some risk out of your portfolio. We have indeed seen a shift over a lot of the year away from the high flyer, more volatile stocks into the more value names, which have underperformed for a long time. Those names that I think Margaret was saying she likes more in the consumer stocks, the consumer durables, those more defensive names. I would also say that you can look at some of the healthcare names very selectively in tech. And I think at some point you still have to look at the financials. But defense makes sense. You can't look up and be surprised at this added volatility, though I think it's a little early yet to be planning the bull market's funeral.